Deckers Outdoor stock is down 19% pre-market after reporting their most recent quarter's earnings. Now, this stock has been a Wall Street darling. If we look back, in 2024, the stock doubled before crashing now about 50% in 2025. So I always love to find Wall Street darlings that are finally getting beaten down because one of two things has probably happened. One, the company was not as great as people thought. Or what's more likely is that the stock just got ahead of itself and it's still a great company, but now it's coming down to a more reasonable valuation. So today, let's look at Deckers Outdoor, which is a shoe and apparel company, and find out if this dip, 19% after already falling so much, if this presents a buying opportunity for a great company, or maybe if we should steer clear. So like I said, Deckers is a footwear and apparel company. Some of their most popular and growing brands are UGG and HOKA, but they also have a couple of other brands that you can see here, Teva and Anu. Their history is quite interesting. They were founded in 1973, and their key product was a flip-flop, a Deckers flip-flop. Their slogan was, "For the space below your feet." I just really like that. In 1995, they acquired UGG, and then they continued acquiring these other brands to build up sort of a fashion holding company. And in the past, I'd say maybe 2 to 3 years, HOKA especially has been incredibly popular. We had that whole Gorpcore movement. If you're unfamiliar with Gorpcore, it's essentially where dudes were dressing like dads going on a hike. You were seeing the rise in brands of Arc'teryx, HOKA, Salomon's. These sort of hiking outdoors apparel brands were seeing a lot of sales because people thought it was really trendy to dress like you were going on a hike. And sure, more people probably were going on hikes, right? We had the virus times that made people feel a little bit cooped up and they wanted to get outdoors a bit more. So I think that's part of the reason why the Gorpcore movement took off. But that trend has really stuck around, and HOKA has become a very, very popular brand. And I think part of that is especially some of the legacy brands sort of falling from grace. You see, Nike with falling sales. And while Nike's not a direct competitor, I think that also had a bit of an impact on HOKA's success. So let's find out what happened with this earnings report now that we know a bit about the history of the company. Basically, growth is still very strong for Deckers brands. They saw year-over-year revenue, which increased 16%. So that's quite impressive for an apparel company. When you think about apparel, this isn't some kind of software company. This isn't a tech firm. This is clothes. I mean, this is clothing. And the fact that they were able to increase their sales 16% to nearly $5 billion is quite impressive. Where does that come from? How are they able to do that? A lot of that is international expansion, as well as, like I said, the popularity of that HOKA brand. They actually break down their sales growth by brand, and we can see that UGG sales, which is those fuzzy boots, other things too, right? They make slippers, they make, when I think of UGG, I think of those fuzzy boots. UGG sales grew 13% year over year. HOKA sales grew 24% year over year, so way outpacing anything else. Other brands actually decreased about 9% year over year. So clearly they have two winning brands and a bunch of other garbage. Sorry, that's a bit harsh, but really HOKA is where the brand is showing the most promise. So if the company is growing so quickly, why is the stock down? It comes from their guidance. So management did hint that tariffs were going to cause a bit of uncertainty going forward. They say the global trade environment has introduced greater near-term uncertainty. They say we're very confident about the exciting opportunities ahead for HOKA and UGG. They don't mention the other brands because they're not growing. They say they view HOKA and UGG as industry leaders. I tend to agree. I think HOKA does see some competition from Salomon, like I mentioned, maybe other brands. Brooks On Running is also quite popular. Different niches for sure, but we're seeing those kind of new brands of shoes really taking off lately. So they say global trade environment introducing near-term uncertainty. What does that look like? Well, they didn't provide annual guidance. All they have is first quarter guidance. So they have an odd fiscal year. So the 3-month period ending June 30th is their first quarter of fiscal 2026. I don't really like fiscal years, but there's usually a reason for it. For companies like this that are very cyclical, you might have more sales in certain months, right? When people are more outdoors. But anyway, they're looking at sales for that quarter, this upcoming quarter of, we'll call it 900 million at the midpoint. Last year in that similar quarter, they had sales of 825 million. So if we just do the simple math, 900 million minus 825 million over 825 million, that's growth of about 9.1%. So I can definitely see where the market was a bit unhappy with these results. We just saw annual revenue growth of 16% year over year, and now they're guiding to A, no guidance for the full year, and B, only 9% revenue growth guidance for the first quarter. So we're definitely seeing a deceleration in growth. When we look at Morningstar, they also called out the fact that no specific fiscal 2026 guidance was given. And they say, even though sales growth and margins may have peaked, HOKA and UGG have growth opportunities. So it sounds like what we're seeing is perhaps they've already hit max growth mode and that growth is going to decelerate going forward. Does that mean the stock is not a buy? Does that mean that this is no longer a growth stock? Does this mean that the company is dead? I'd say no. I gotta take a sip of my Starbucks here. I would say no. I think it's very natural for any high growth company to experience a growth slowdown. And it always baffles me that the market is surprised by this. Sure, sometimes it happens sooner than people expect and that type of thing, but it's impossible to continue growing at double digits forever. At a certain point, you're going to hit your capacity, right? The market is going to be saturated. You're going to have to see revenue growth slow. It just is a fact of life with any business. So the fact that they are still growing 9%, it's definitely a slowdown, but I'd say that that's acceptable growth. And what we'll do is look at the valuation and see if that valuation makes sense. So this is my growth stock spreadsheet where I analyze growth stocks based on 4 factors. Those are valuation, which I measure by price to annualized sales. I also look at revenue growth, gross margins, and the overall size of the company, which I measure in annualized revenue. So I reward companies that have claimed more market share, and I punish companies that are a bit smaller, and I reward companies with strong growth, high margins, and a low valuation. So what we can see here is that Deckers, after I put in the expected drop, is getting a very solid score. So the average score for my spreadsheet is 12.2 when I rank on those 4 factors, and Deckers gets 13.3. So all you need to know with that is just that this is an above average company in terms of valuation, growth, and margins. So my spreadsheet so far likes the company. When we look at valuation, price to annualized sales is 3.2. So they made about $5 billion last year. They're valued just over $15 billion this morning after the drop, right? So I would say that's not unreasonable. What we need to do is compare that to some other apparel companies. So let's look here at Lululemon, price to annualized sales of 3.6, right? Very, very similar, very on par. On running, so they're much more highly valued than Deckers. So with those comparisons, I would say that this is a very reasonable valuation for Deckers. I wouldn't call it a screaming buy or anything that's extremely undervalued, but it definitely looks promising. When we look at other valuation ratios, PE, that's their price to earnings, is sitting at about 20.5, and I think that's even before the drop, so that might be lower. The apparel industry tends to have lower PE ratios just because it is so cyclical, and there tend to be not a lot of moats. So I would love to see that a bit lower, perhaps in the teens, maybe low teens. But, like I said, I think this is not adjusted for the drop this morning, so that might actually be in that range. Free cash flow, we see price to free cash flow that's actually lower than price to earnings. I love that. That means they have better free cash flows than they do earnings. And what we can see is that those free cash flows have just been on a really strong upward trajectory over the past few years. So this is 2024 here. They saw a record free cash flow of nearly $1 billion. That's amazing. So valuation looks very reasonable. Like I said, 16% revenue growth. Even though we know that's going down to 9, Deckers does have a history of beating estimates, so I'm not going to plug in 9 into the spreadsheet yet. I'm going to wait and see what they actually do. But keep in mind that this spreadsheet is sort of a rear view mirror approach, so I'm talking about revenues that they've already achieved, growth that they've already seen. Looking forward, this is going to look a bit more bleak. There's some other factors on the spreadsheet that I don't include in my rating, but I like to look at, so things like international sales. Deckers makes 36% of their revenue from outside the United States, and I think that's going to be a significant growth opportunity for the company going forward, expanding into other countries besides just the US, which is their core market. And we also see that they are quite profitable, gross margins of 58%. That is a high for them. It's typically a bit lower. And of that 58%, 59% goes to SG&A. There's no research and development. Like I said, this is not a tech firm. So they do have the potential to be quite profitable. And they've had net profit margins around 18%. I think that's quite incredible. For reference, I always benchmark against Hermes. So Hermes is a French luxury company that is very exclusive, has insane profit margins of 30%. So you're never going to get anything like that with another apparel company. So I like to use that as a benchmark to say, okay, where are they on the Hermes scale? They're about halfway to Hermes, which is actually quite impressive. So 18% profit margins last year. Let's compare that to a Lululemon, 17% profit margins. So clearly this is a premium brand like Lululemon that can command those nice margins. And debt to long-term equity of just 10%. Nice. So that means they have a clean balance sheet. So it's my favorite time of the video. We're going to look at the balance sheet. They have cash of nearly $2 billion. Amazing. I love it. I love when they have a strong cash balance. When this is a $16 billion company with $2 billion in cash, that gives them so much flexibility. And as we already know, they've built their company by acquiring these strong up and coming brands like HOKA, like UGG. So Maybe there's an up and coming brand that they might want to acquire for $1.5 billion. They have the option to without diluting shareholders. So I love that. We can look next at the current ratio. This is the company's current assets compared to their current liabilities. How many times over can they pay off their current liabilities with their current assets? Now, these are things that either can be turned into cash within a year, current assets, or debts that come due within a year, current liabilities. We say that they have current assets of nearly $3 billion, current liabilities of less than $1 billion. So they have a 3 to 4 times current ratio. Very, very strong balance sheet. I love to see it. So, okay, final thoughts. We have a reasonably valued company that is still growing, has some very strong brands, HOKA and UGG, great squeaky clean balance sheet, making some strong free cash flows, seeing some near-term uncertainty due to tariffs. However, it's very possible that the market is getting a little bit pessimistic on the stock. We see that year to date, the stock is down 38% and then another 19% pre-market. So we're looking at a 50% drop within, not even 6 months. So obviously you can't look at short-term performance and make any kind of, assumptions or anything there. What we need to do is look at that valuation. Like I said, valuation looks very reasonable. It definitely does seem to be a premium product because they do have those strong, nearly 60% gross margins, 17% net profit margins, halfway on the Hermes scale. They do have a strong international presence that is growing, and I think they do have some good financial prudence because their SG&A expenses, that's selling general administrative, is on the lower end for an apparel company, and they have that squeaky clean balance sheet. Additionally, one thing I did not mention is that they did increase their share buyback authorization to $2.5 billion. So that means with some of those strong free cash flows, I said they had $1 billion in free cash flow last year, some of that is going to be going to buying back their own shares. This is, in my opinion, a great way to provide confidence in your business. So if a company buys back their own shares, they're saying, hey, we think our shares are cheap. And also it's very good for the current shareholders who have been on this tumultuous ride because as the company buys back their own shares outstanding decreases, which means that your shares then represent a larger and larger portion of the company. It's the opposite of dilution when a company sells their shares to raise money, which is usually the sign of a desperate company. A company buying back their own shares shows a very calm, cool, and collected company. So I like to see that. So I know I commented that maybe they might make another acquisition with all that money. It sounds like maybe their first priority is share repurchases, and then perhaps maybe they can make some strategic acquisitions in the future later on. So to me, I am going to be looking to potentially open a position in Deckers today. I definitely want to see where it opens, do a little bit more research, compare it to some of my other holdings, make sure there's not too much overlap with things like Lululemon. But I do believe that this is a strong quality company that may be trading at a discount today. So if I do decide to open shares, I'll definitely let all of my YouTube members know. I have a YouTube membership where I post all of my buys, sells, and rationale behind that. So if you'd like to support the channel, that's a great way to do so. But another easier, better, cheaper / free way to support the channel is simply to subscribe if you're new, and please hit the like button if you liked the video. And honestly, if you didn't like the video, please hit the dislike button and tell me what you didn't like, because I really am trying to make content that people like. So if you don't like a certain type of video, please tell me so that I know what people like. Thank you guys so much for watching the video, and I'm so sorry that I haven't posted in a while. I'm going to try to be a bit more regular in my posting schedule, just have had some significant life events going on. So nothing bad, definitely nothing bad, just, keeping me busy. So hope you've all been well, and thanks so much for watching the video. Hope you have a great day.